Northwest Health is one of Canada's more popular REITs, but I think it is time this healthcare REIT drops in for a checkup. Hold on to your free healthcare, folks. This is going to be a good one. Northwest Healthcare Properties REIT was founded not too long ago in 2004, and they are a global real estate investor primarily with properties as well as some partnerships that focus on healthcare, knowledge, and research. They have more than 230 properties worldwide, including Canada, the US, Brazil, Germany, the Netherlands, the UK, as well as Australia and New Zealand. I have said this before, but healthcare is a sector to watch as the baby boomers push deeper into their golden years. As they do so, the demand for healthcare services, including medical treatments, preventative care, and specialized facilities, is expected to, well, surge. This demographic shift presents a significant opportunity for the healthcare sector, with potential for increased revenues and, of course, expansion. As the healthcare overall benefits from this upturn in the sector, so will this REIT, as there's nothing better than stable, reliable tenants who may just want more properties to boot. Join the conversation. Let us know in the comments your favorite REITs. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. Before we go any further, we do need to address the elephant in the room, as in the tax situation that comes with REITs. A REIT is structured in a specific way to pass on the tax, well, to you. What that means is that the REIT does not pay taxes on their profits, as they simply pass them all on to you. This is actually pretty good, because that means the dividends are a little bit bigger than they would be if they had paid taxes first. Provided you place your REITs in a registered account, like, well, your TFSA or your RRSP, you are fine, and you can forget about the tax man, as he is not coming a calling for you. However, outside of a registered account, your REIT dividends are 100% taxable. They're treated almost the same as interest is. With that out of the way, I really want to get into these fundamentals, as I fear the higher interest rates may be a factor as we figure out if this REIT is still worth your investing dollar. So for that, as always, we will call on our good old buddy, Mr. Math. So, to begin, let's take a look at that surface data. They have a market cap of $1.57 billion, and their beta is slightly less volatile than the market average at 0.843. Their earnings per share, that comes in at negative 0.93. Yikes. That is not unexpected, but yet I still cringe a little when I see a negative sign. Their price to earnings ratio, that comes in at negative 6.60. The average in their sector is 29.4. But however, and you guys have seen this before, with a negative PE ratio, the data is not so great for comparing to other companies. So we will have to take a look at their price to sales ratio, which comes in at 3.20. The average in the sector, 5.60. This price to sales ratio is actually not too shabby compared to peers like, well, Killam Apartment REIT has 6.1 and Crombie REIT has a PE ratio of 5.4. Okay, and if we also take a look at that price to book ratio, it comes in at 0.671. The average in the sector, 0.80. So this is also pretty decent. Now, when we do get to the return on equity, that comes in at negative 4.90%. I absolutely hate a negative ROE, but once again, it's not actually unexpected. Overall, their surface data was pretty much what I was expecting, and it does gel with what we would expect to see with a REIT in a rising rate environment. Let's go a little deeper though, and we're going to take a look at their cash situation. When it comes to revenue, they came in at $484.55 million, though their earnings come in at negative $231.68 million, hence why they had negatives in their surface data. Their projected earnings, definitely a bright spot, 96.74% per year. That's fantastic. The industry itself is forecasted to grow by 24.6%, so that is not bad at all. Their free cash flow, that comes in at $174.00 million, and their operating cash flow comes in a little higher at $174.76 million. They are forecast to become profitable again within 3 years, so we do have some hope on the other side for sure. Of course, I am definitely very interested to see what their fair value is. So their current value right now comes in at $6.32. Using a discounted cash flow model, we do get a fair value of $7.22. That puts them as being undervalued by 12.4%. I would absolutely agree with that. In fact, I would almost say it might be a little higher. Once again, we are not surprised with the cash situation, and it honestly could have been much worse. We should take a look at their returns next. They have a dividend yield that comes in at 12.36%. It is paid out monthly in the amount of 6.7 cents per share. Holy banana bread, that does look good, but it is not sustainable. And when we look at their payout ratio, that comes in at 108.0%. Once again, not sustainable. I will though admit that I expected that ratio to be a little higher. On the good news front, they have not cut their dividend, and it has been the same for the last 3 years. That is of course a good indication that cutting that dividend is something they will not take lightly. Let's actually look at their returns though. On the 3-year, their price fell from $11.51 to $6.51. That is a return on investment of negative 43.48%. Factor in the dividends, we do get a total return of negative 22.53%. When we look at the 1 year, their price fell from $13.04 to $6.51. That's a return on investment of negative 50.12%. Adding in the dividends, we get a total return of negative 43.95%. You can clearly see that the drop came in the last year. Before that, if you had looked at the first two, they had a positive ROI of just over 13%. However, what has happened in the last year? Well, rate hikes as well as a bear market. Let's take a quick look at 2023. Their price, well, it still fell from $9.55 to $6.51. That is a return on investment of negative 31.88%. Factor in the dividends, we get a total return of negative 26.97%. Looking at this year, you can see a wee bit of improvement, and I do think it will get better once the rate hikes stop and the market becomes, well, more bullish. It is that time to bring this deep dive home, and to do that, we need to take a gander at their debt. They have a total debt of $4.00 billion and a total equity of $3.38 billion. That makes their debt to equity ratio 118.4%. In terms of this ratio, it has actually come down from 180.8% over the last 5 years. This is not bad, even though their overall debt has actually increased, but at the same time, those equities have luckily increased even more. When we look at their cash and cash equivalents, that does come in at $126.03 million. Let's take a look at the short term. On the short term, their assets come in at $382.76 million, and their liabilities come in at $967.31 million. I would have loved to have seen those liabilities come in smaller, but it is what it is. When we do switch over to the long term, their assets come in at $7.68 billion, and their liabilities much better, $3.71 billion. Overall, their debt situation is not as bad as I had expected. With rising rates, a REIT naturally is expending more cash on their mortgages, so you expect it to be bad. However, I think with Northwest, we have a situation where their clientele is not the sort to default, and this has been good for them. However, with their current cash flow, that debt is not well covered by their operating cash flow, and that interest as well, it's not covered by those negative earnings. So what is the final verdict? REITs are normally a great source of passive income and can be a staple for many dividend-focused portfolios. For the most part, this is still true, but you may have lost some of your capital as REITs have taken a big hit in the bear market and that rising interest rate. With Northwest Health, we do have some benefits in that they do not rent properties to higher default likely people or companies. That alone will more than likely mean they will be fine on the other side. But the question still is, are they a good investment? If you are a growth investor or even a total return investor, then it is not on the surface a great investment. However, on the other side of the rate hikes and the bear market is a chance for some pretty serious recovery. This is something that could make some money, though you may want to get out once the recovery is complete, as there will be better options once the growth is off the table and the yield shrinks back to the vicinity of 6%. For the long-term investor, this is more than likely not a great choice, though you can always switch it up and ride it up for that growth if you want to. For, of course, the passive income, this is a great yield, and if they do not cut their dividends, you will have a reliable 12% yield in your portfolio. Even once it recovers, you still have the 12% based on what you paid for it. All of these scenarios do hinge on them not cutting their dividend. I do not think they will cut it, and if they do realize their projected earnings growth, it should not be an issue maintaining it. There is opportunity here, but there could be more pain first if the rate hikes keep coming. So even though it could be fun riding this growth train back up, this one does come with a little bit of extra risk, and you really want to make sure you do your own research on this one and decide if it does match your risk profile before you throw any of your hard-earned money on the table. Keep the learning going. Watch my video on US buy and hold forever stocks linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.